Welcome to today's Retirees with Wayne Maslick, Certified Financial Planner, a program designed to educate you on family-focused retirement and tax planning. Today's Retirees is brought to you by Great Lakes Benefits and Wealth Management and Alan Thorley Deloitte Insurance.
And welcome to this edition of Today's Retirees with Certified Financial Planner Wayne Maslick of Great Lakes Benefits and Wealth Management. Wayne, we have been talking a lot of things over the past several weeks. Taxes and life insurance and all of these kinds of things. Today we're going to sort of shift gears just a little bit and talk about the stock market.
The stock market. Yeah, the stock market's been wonderful. If you have money in the market, you have been making money. Market's up. You know, the market low was back in March of '09.
That was after the bailouts and all of that kind of
Yeah,
stuff?
after the nightmare 2008 and into 2009 when the market has dropped 40%. We've rebounded nicely. The S&P 500 index was sitting at about 670, 680 points back in March of '09. It's 1,350 points now. I mean, it literally, the stock market has over 100% return.
Wow.
We were talking off air gold and how much gold has been up, and gold has doubled in price. Well, so has the stock market. So the stock market has been keeping pace with gold. The stock market is a good place for some of your money. Some of your money, that's what we're going to talk about today, not having too much money in the market. And because of the market's growth here in the last couple years, a lot of people's whole financial portfolios out of whack a little bit. They may have too much money at risk now because of the growth of the market. So that's one of the things I want to focus on today, making sure our ratios are in order and kind of looking into the future as to what we could expect from the stock market.
Now, we have talked on previous shows about those the rule of 100, and this is what you're talking about a little bit about being out of whack. If the growth has been almost exponential over the last few years, if you're 70 years old, you may have more than 30% of your wealth in the stock market, where you want to try to back that up.
Right. To recap the rule of 100, and that's something I like to generally start with people. Some people are more risky than that and don't mind it. Some couldn't imagine having that much money in the market. And for our viewers and listeners, I'll just recap it. If you take your age, say a 70-year-old like you just brought up, and you subtract that age from 100, so that would leave us 30, no more than 30% of your investable assets should be in risk accounts. And risk accounts are accounts that can go backwards, where in any given month or any given quarter you can see a negative on your statement. That is a risk account. Now, there's varying degrees of risk, but if an account could go backwards, it's risk money.
Right. Now, a lot of our viewers and a lot of our listeners probably are sitting like me. I'll just admit. And we have almost all of our dollars in mutual funds and things like that, which, historically I was always taught, do that, and it's almost risk-free because you're really diversified. Yeah. But that's not really the case, is it?
Yeah, well, they say historically, like, over the last 70, 80, 90 years, so I don't know if you'll be around then. But yeah, historically the market has averaged a nice rate of return. But, we do have these cyclical bear markets and bull markets and these big bear and bull mega trends that go on for years. Remember, in March of 2000 now, that's when this whole bear market started. We are still in a big bear market, a bear market that started 11 years ago.
Sure.
We're still not back up to those numbers. You remember when the Dow was at 14,000 and that, and we're still not back there yet.
Exactly.
So in these last 10, 11 years, we've seen some little cyclical bull markets. We've seen some cyclical bear markets, opportunities to make money and also opportunities to lose money. So that's why you have to be able to keep your money in the markets for a long time. You have to be able to wait out those market corrections. So because of that, we got to make sure we don't have all of our monies in the markets. We have to have a degree of safety. And the older you get, the more safe you need to be. And that's why we use the rule of 100.
And as we have gone through a lot of these programs and a lot of the instruction that you are teaching us, it's become more and more clear why you are doing and recommend some of the things you're doing. I have a friend who years ago told me, when you buy a stock, always plan a minimum of 7 years, because all kinds of weird things happen, and usually in 7 years you can make money on that, if you're buying individual stocks. Is that something that you have seen?
Well, I look at it a little differently. I mean, the rule in general is good. I mean, Warren Buffett says if you can't hold a security for 10 years, you shouldn't own it for 10 minutes. So it's kind of along the same lines. But just because you bought a stock doesn't mean you hold it indefinitely. The buy and hold forever thing, that's not the case. You buy the stock, but you still need to be aware of that stock and the company you own and what's going on in that company. If, for instance, some things start to look negative in that company, you don't like the way it's being run, a new owner takes over, new board of directors, lawsuits abide, there's a new competitor in the industry, then you may not want that particular stock. You may sell it and get another stock, but you're still in the market. The money's still at risk, and that's what I look at as far as the timeline.
Now, we're going to take a little break here. When we come back, what are 3 or 4 of the questions that we're going to be talking about?
Well, when we come back, I'm going to go to the board. I'm just going to lay out the rule of 100, and I want to get people to think about their risk and their safe ratios. Because if our money was, if you're a 50-year-old and you had 50 and 50, 2 or 3 years ago, you're not there anymore. Your 50% risk may be up to 60 or 70% risk. So you have to peel some of that off and get it on the safe side.
All right. Well, we are going to take a little break right here. Come back. Wayne's going to go to the board. Stay right there. You don't want to miss this program about the stock market.
Schedule your appointment with Wayne today by calling 866-626-3990 or visit todaysretirees.com.
Wayne Maslick is a certified financial planner, which is the standard that all other financial advisors are measured. What this means to you is simply this: credibility. As a certified financial planner, Wayne assists you in family, estate, and tax planning from an independent perspective, not from a sales perspective. Wayne does not work for an investment or insurance company, but gives advice based on your family's unique needs, not the sales goals of an insurance or investment firm. Call for a free consultation with Wayne to see how to reduce your existing or estate taxes, better use the retirement funds you have, or plan for the retirement that is fast approaching. Call toll-free 866-626-3990.
Allen Thorley Deloitte Insurance has been locally owned and represented for over 100 years. That means if catastrophe happens, we've probably seen it, and we'll walk you through the process of making everything right again. Representing some of the finest insurance companies in the industry, Allen Thorley Deloitte shops for you, giving you the personalized service, advice, and coverage you deserve. Yes, it's really that simple. Let us customize a plan for your personal or business insurance needs at 800-628-1057 or visit atdinsurance.com.
Find out why Wayne Maslick, Certified Financial Planner, is the right choice for you.
Many do-it-yourselfers read and watch the financial shows, but when you look at the actual rate of return that they've earned on their investments, or when you look at the state of their estate plan, are the documents updated? Is everything in line? A lot of times it's not. So those folks, if they're not doing a great job themselves, they need to come in and see me. Call the office, talk to my staff.
And welcome back to this edition of Today's Retirees with Certified Financial Planner Wayne Maslick. Today, Wayne, we are talking about the stock market. And as we went to our break, you said you were going to go to the board, which we are doing now.
Yeah,
$1 million.
This $1 million, hey, some of our listeners have more than that.
That's right.
And, a lot of folks have a lot less. It doesn't matter. If you're going to invest X amount of dollars, and you're putting it away for the future, generally retirement.
Right.
It doesn't matter the dollar amount. Some people wish they had $1 million. Some are saying, is that all you're,
But just going from that, if a person planned well and they started when they were first getting the jobs out of college or whatever,
they'll have $1 million.
they'll have $1 million
Yeah.
when they reach that 65, 70 years old range.
You would be surprised how many people have that kind of money. I mean, it doesn't take long if you're working in a career 20, 30 years and you're socking away 10, 15% and you're averaging a decent rate of return, you're going to have that kind of money. I mean, it's just...
Takes discipline, doesn't it?
Takes methodic discipline that, and time. And time. Or an inheritance or two.
Yeah.
Which is
that always helps, right?
In some place. But yeah, you know, April's over here. April, we had another upswing in the market, and it was like the 8th positive month in a row for the market.
Sure.
The market is on a nice rebound. We're in a little cyclical bull market that started in March of '09, and the market is up over 100%.
Wow.
So let's say, you know, we did some planning a couple years ago. We allocated our $1 million or 100,000 or 300,000, doesn't matter. But using just round numbers, $1 million bucks, and you're a 70-year-old, if you look here, the rule of 100, your age on a scale of 0 to 100, 70-year-old. So 70% of that person's assets should be in safe accounts, and then they can go ahead and take risk with 30%. 30% of the million, 300 grand.
Okay.
So a couple years ago, we invested. With the 300 grand, they could have either taken the conservative approach, you know, just a little bit of risk, not trying to, you know, light the world on fire, you know, not wanting a lot of big downswings. Moderate approach. The moderate approach is more like the mix-up of the stock market with some bonds thrown in there.
I see. Okay.
And the aggressive approach, which is, hey, all stocks, mainly concentrating on growing our money. So if you were kind of middle of the road, you should have kept pace with the market. And since the market went from, I'm talking about the S&P 500 index, went from about 680 points, 670 points 2 years ago to 1,360 points now.
Wow.
It doubled.
Yes, absolutely.
So this 300,000 is now 600,000.
Wow.
Right? So it grew. Our million is now $1.3 million, plus the growth we had on the safe money. And on the safe money, you should be earning 2 to 7%. And yes, we have accounts, we've talked about them on previous shows, where you're getting, you know, 5, 6, 7% on your safe money accounts. We'll leave that for another show, but you should be earning between 2 and 7% on all your safe money.
Okay.
So you had a $700,000 portfolio in this example, growing at 3 or 4 or 5%. So we're making, at 4%, you know, we're making $30,000 a year on this. So this will be up to, you know, 780, 790, 800,000. This doubled because of the horsepower of the stock market.
Right.
So now our million is now $1.4 million. So we have to do it all over again now. Periodically, you need to sit down, look at your risk and safe ratios, and then reposition. Okay, so if this is 600,000 now, and this is 800,000 now, we're way out of whack.
Right, I see, right.
So what we have to do is take some money from here, from the risk side, and get it over to the safe side.
Right.
And get your ratios back in order.
Sure. Now, when you, just to recap for our folks that, you know, people tune in and out, safe money, in this, you know, it could be any number, but is money that is invested safely that does not go backwards. Is that correct?
Does not go backwards unless you made a withdrawal.
Okay.
Unless you're taking income or you went in and dipped into it. This also is a good time when the market's up like this to where if you are taking income or you have a purchase coming up, automobile, you know, room addition, summer home, you know, big vacation, the market money is a good place to go get your money. Take some of your profits and go do what you were going to do with it. You know, go spend it. You know, that's why you saved it.
Right.
Right? Not so you can pass away and your kids will inherit it and burn through it in a few years.
Right.
Enjoy it. When we have good years, peel some money out and go use it however you want to use it. Use it, donate it to charity, take your trips, buy your cars, give some to your kids, your grandkids.
Sure.
Now's a good time to do that because of the growth we've had. That growth isn't going to last forever. At some point, the market will start correcting and go the other way. Right now is a good time to potentially take our profits.
Sure. Now, is there, like on this 100% growth that we were speaking about over the last couple of years in the stock market, is that a taxable numbers?
It depends, okay?
Depending on where you had it?
Yeah, if the money's in the stock market and you have monies in retirement accounts, like IRAs, 403Bs, 457 plans, then no, all that growth for that time period is tax-free. I mean, you're going to, the government's going to come and collect it at some point, but not now if it's growth. Now, if we had some capital gain in non-IRA stocks, non-retirement accounts, and we did take some profits, yes, you may have some tax. And when we come back from the break, I'm going to talk to you about that tax, because a lot of people don't sell because they're afraid of the tax, and it's no big deal.
Okay. Well, folks, we're going to be right back. This is all the time we have for this segment. This is Today's Retirees with Certified Financial Planner Wayne Maslick. We'll be back right after this.
Schedule your appointment with Wayne today by calling 866-626-3990 or visit todaysretirees.com.
Wayne Maslick is a certified financial planner, which is the standard that all other financial advisors are measured. What this means to you is simply this: credibility. As a certified financial planner, Wayne assists you in family, estate, and tax planning from an independent perspective, not from a sales perspective. Wayne does not work for an investment or insurance company, but gives advice based on your family's unique needs, not the sales goals of an insurance or investment firm. Call for a free consultation with Wayne to see how to reduce your existing or estate taxes, better use the retirement funds you have, or plan for the retirement that is fast approaching. Call toll-free 866-626-3990.
Allen Thorley Deloitte Insurance has been locally owned and represented for over 100 years. That means if catastrophe happens, we've probably seen it, and we'll walk you through the process of making everything right again. Representing some of the finest insurance companies in the industry, Allen Thorley Deloitte shops for you, giving you the personalized service, advice, and coverage you deserve. Yes, it's really that simple. Let us customize a plan for your personal or business insurance needs at 800-628-1057 or visit atdinsurance.com.
Find out why Wayne Maslick, Certified Financial Planner, is the right choice for you.
Then there's folks that need to come see me that maybe are a recent widow or widower and just need some help getting their financial house in order. Or there's folks working with current financial advisors or brokers, and maybe the brokers are taking too much of their money at risk, losing it to the stock market. So come see me, folks. Call the office and set a time that's comfortable and convenient for you. And
now back to Today's Retirees with Certified Financial Planner Wayne Maslick.
And welcome back to this edition of Today's Retirees with Certified Financial Planner Wayne Maslick. Today we are talking about the stock market and the risk reward of that decision to be in the stock market, and also for those of us as we age, that rule of 100, which we have been talking about. Safe money should be our age, should be 70% of our age. Is that the way I need to say that?
If you're 70.
If you're 70.
Yes.
Where's my brain today?
If you're 50, half of it. If you're 60, 60% of your money could be in safe accounts, and you take risk with 40%. Right. Every person has a different risk tolerance and risk threshold. Every family does. The husband may have no problem gambling more of their money in the market.
Well, most of us are gamblers to a certain extent.
Yeah, absolutely. And then maybe the missus wants a little more safety and security, especially the further into retirement folks go. But so you come up with a ratio as a family, or as if you're single as an investor, and then you stick with it. Moving forward.
Absolutely, and as we've talked through the months here, and the folks see the ads and the workshops, all of that. What I'm learning over and over and over is a good, sound financial plan is essential to success.
Yes, and in order to get one, you have to work with a good, sound, certified financial planner.
Correct.
And there isn't many of us around. I mean, just in this area, there's only a handful, if that. And I'm the only independent certified financial planner. The others work for banks or brokerage firms. So, but not that that's a negative thing necessarily, but you need to find somebody that fits you. I like being independent, so I can go to the whole world of investments to pick for my clients. I don't have to show ones that for a company I work for.
Sure.
But back to your question, is there going to be a tax if I sell?
Right.
Because I was talking about maybe potentially taking some profits from our earnings. If it's in a retirement account and we have the gain, there is no tax. Now, if we take a withdrawal and we take money out, then yes, we will owe tax on that money because it's coming out of a retirement account.
Okay.
So we have to plan for that. We always talk about tax planning. Don't just make a move. Talk to your CPA, talk to your planner, and don't just cash in 50 grand, because that could totally mess up your tax situation. It could bump you to a new bracket, could cause you to pay more tax on your Social Security.
Sure.
But let's look at the other way. A lot of people don't sell because they're worried about the capital gain. Because we can sell a holding in a retirement plan and not pay tax as long as we leave the money in the plan. But if it's not in a retirement plan and we sell an asset at a gain, we have tax to pay. So a lot of times people hold on to a stock or a mutual fund or anything too long because they're worried about the tax. So I want to put things in perspective here. Just a real quick example. Say we had a $100,000 investment. That's the cost basis.
Okay.
Then it grew to grew to $200,000. So we doubled our money, kind of just like what the market did in the last couple of years. So we have a $200,000 investment. If we sell the whole thing, we're going to pay tax, not on the 200, just on the gain.
Sure. Okay.
And it'll be a capital gains tax rate, 15%.
Okay.
So we're going to owe just approximately 15 grand because we liquidated the entire holding.
Right.
People are saying, why would I don't want to do that. Now, can the market go down, let's say 10%, do you think?
Oh, sure.
Absolutely.
Yeah, we've seen it go down more than that.
So let's say we don't sell because we don't want to pay the tax, and then when the market has a correction, it just goes down 10%, which is nothing. Our $200,000 is now down to $180,000.
Wow. Right.
And we still own the holding. We still would need to liquidate it at some point. We're not going to hold on to it indefinitely in most cases. So if the market just drops 10%, we're down to 180, and we still own the holding, and we still owe the tax whenever we liquidate. Whereas if we sell, we write a check for 15 grand, we're out of the investment, we pocketed 85,000 in profit,
right,
and the tax liability is now over with.
Wow.
So, this is a general example.
Sure.
Don't not sell a holding, maybe a holding that's inappropriate for you now,
Right.
just because of the tax.
Right. Well, that's, again, it goes back to the importance of planning, the importance of sound advice, and planning ahead and looking and seeing what needs to be done. Excellent advice, Wayne. Folks, this is one of the reasons that Wayne does this show, is for you to pick up the phone, give him a call, 866-626-3990. He'd love to sit down with you. The first consultation is free. Just do that, and I'm sure he'll take the time to go through your individual plan and see what or if he can help you with that. We'll be back right after this.
Schedule your appointment with Wayne today by calling 866-626-3990 or visit todaysretirees.com.
Wayne Maslick is a certified financial planner, which is the standard that all other financial advisors are measured. What this means to you is simply this: credibility. As a certified financial planner, Wayne assists you in family, estate, and tax planning from an independent perspective, not from a sales perspective. Wayne does not work for an investment or insurance company, but gives advice based on your family's unique needs, not the sales goals of an insurance or investment firm. Call for a free consultation with Wayne to see how to reduce your existing or estate taxes, better use the retirement funds you have, or plan for the retirement that is fast approaching. Call toll-free 866-626-3990.
Allen Thorley Deloitte Insurance has been locally owned and represented for over 100 years. That means if catastrophe happens, we've probably seen it, and we'll walk you through the process of making everything right again. Representing some of the finest insurance companies in the industry, Allen Thorley Deloitte shops for you, giving you the personalized service, advice, and coverage you deserve. Yes, it's really that simple. Let us customize a plan for your personal or business insurance needs at 800-628-1057 or visit atdinsurance.com.
If you would like Wayne to answer your question on the air, send your message to wayne@todaysretirees.com or call 866-626-3990. Here's today's question.
And welcome back. Today our question, Wayne, is about the topic we've been talking about. So I realize that I'm out of whack in this market. You know, I've got some safe money, my risk money are out of whack. So the repositioning of this, the timing, should I wait until, you know, the market goes up another 3%, or should I just sit there and wait till I see it start to drop and then I jump and run?
Yeah, this is, you mean try and time the market.
There you go.
Yeah, that's a tough call because people do let their emotions get involved. They let the greed get involved. Hey, I doubled my money in the last couple of years. Let's keep on that track and let's try and do it again. So they go ahead and they still keep too much money at risk, even though they know their ratios are out, because they're going to wait till they think the market run is over and then try and make the move.
Okay.
But a lot of times, you know, they get bit in the butt, like in 2008. You know, 2007 was looking great, right? And they stay in the market. Now 2008 happens and it drops pretty quick, pretty fast. So no, you know, you have your periodic reviews. Like when people come in and we have our periodic reviews, clients that have been with me for years, that's when we make the move. We run the math, we see the ratio, and then we reposition the way we have to. Yeah.
So,
now if the market's bad, by the way, say it is down like in 2008 or early 2000, sometimes we have to go the other way. Sometimes we have to, because the risk money got cut in half, or so now we have to take from the safe side and put in the risk side. So you do it when you see the numbers are off, and you just do it, plain and simple. Now I have people that call me before our periodic reviews that say, hey Wayne, you know, let's get more safe because, you know, our risk money is out of whack, and they know that. They're running the math. Then we do it before our review. So yeah, my answer to the question quickly is no, you don't wait. You just do it.
Well, one of the things that I've noticed as we have gone through these shows, Wayne, is just the simple fact that folks don't succeed because they don't plan well. And I hear it from you over and over and over again. And that's why it's important for folks to pick up the phone, go to the website, todaysretirees.com, get the information, make the appointment, sit down with Wayne.
Even if they're sharp people, they need, even Tiger Woods has a coach.
Sure, absolutely. And this is what's very important, friends. Take the time to go to Wayne's website, todaysretirees.com, fish around there, call him, set up an appointment, go out and see Wayne, and he can absolutely help you. It's all the time we have for this week. We'll see you next time.
Thank you for being a part of Today's Retirees. We trust the information discussed on Today's Retirees has been a benefit to you. To schedule a no-cost or obligation appointment with Wayne, please call our office at 866-626-3990. A free newsletter is available by calling our office or visiting our website, todaysretirees.com. That's todaysretirees.com. Today's Retirees is a service of Great Lakes Benefits and Wealth Management, Wayne Maslick Certified Financial Planner, and is sponsored by Great Lakes Benefits and Wealth Management and Alan Thorley Deloitte Insurance. The information on Today's Retirees and information on our internet website should not be construed in any manner whatsoever as the receipt of or substitute for personalized individual advice from Wayne Maslick or Great Lakes Benefits and Wealth Management.